In this week's update, a warning on most valuations. Lithium had a scorching week and bond yields invert. My name's Gary Davis. As always, this is general advice. Please remember to like and subscribe to the video. Let's start with the normal market perspective and what's becoming really evident now with all of the changes in interest rates and central bank policy, and we've got inflation and we've got headwinds coming from a number of areas, and I think they're going to intensify in coming years. What you need to own, in my view, must have strong and highly probable growth. So not only the prospect of strong growth, but the likelihood that it's almost certainly going to manifest itself. And I think those stocks that don't have that are almost certainly going to fall in price. Now, since the correction, which now has finished, since that started in mid-December, early January, it was really about multiple contraction, a reversal of a 4-decade fall in interest rates, and that just changed the investing scene quite dramatically. And so we've seen a contraction in multiples, but I think there's still a long way to go to play out, and particularly as we are going to see these headwinds probably just become more and more intense. So a traditional diversified portfolio where you own a bit of everything, it's logical to conclude that it's going to struggle because there's not going to be all sections of the market that are going to do well. In fact, I would suggest that at least half the market is going to really, really struggle, and that we're going to see lower share prices in many, many sectors. And that's even if the companies are still performing well. So the share price falls are not about the companies failing to produce profits and advance. This is just a bigger picture dynamic that hasn't played out yet. And so I think we're going to see many high-profile names that are going to be impacted over the next couple of years as the market adjustment continues. So if you own a lot of these, traditional top 200 kind of stocks that common consensus thinking nods its head and says, yeah, they're the sort of stocks you should own for a reasonable return with low risk, I just don't think you're going to get it. I honestly think that a lot of those top 200 stocks in Australia are probably going to fall in price progressively over the next couple of years. And I'll show you an example in just a minute. In fact, I'll do it right now. So I just want to look at Wesfarmers. Now, this is chosen purely as an example. I could have picked a 20 or 30 or 40 other stocks. So there's nothing particular about Wesfarmers. I'm not being either bullish or bearish on Wesfarmers. This is just purely an example and an exercise to show you what many stocks are going to encounter. And Wesfarmers, I think, has been regarded as an absolute blue chip top 20 stock for decades. And so this is the sort of stock that most people would think, well, I'm going to be pretty comfortable if the market goes into a headwind. I'm going to be pretty comfortable with the Wesfarmers, and I probably should do okay. But let's just look at the cold hard facts and why a further contraction in multiples looks likely. So these are the earnings per share numbers from 2016 through to 2023 in cents per share. So back in 2016, they generated $1.49 per share in earnings. And that has been on a bit of a roller coaster, which is the first point, is that the earnings growth of Wesfarmers, I don't think is anything remotely as good as what a lot of people just naturally assume, because it's a big blue chip company, therefore their earnings profile would look really good. But if you look at the actual numbers, 149, 181, down to 107, we managed to make it up to $2.14 in financial year 21. That's expected to come back a little bit in the year that we're in at the moment, and then a bit of a mild increase into 2023. So that's the earnings. And the compound annual growth rate from 2016 to 2023 is a meager 5%. Now, when I did the numbers, that actually surprised me. because my assumption was that something like Wesfarmers would be more like 10 or 12% compound rate of growth. So even I was surprised. I just assumed it would be better than that. And I think a lot of people buy stocks because of, assumptions that just aren't valid. Now, if we look at how that translates into PEs at the time, you can see that Wesfarmers at its low point tends to be in the high teens, somewhere close to 20 PE, and peaked out in 2018 at 35 times. That was when the market was, pretty bullish on Wesfarmers in the middle of 2018. But since then, it's been fluctuating around the midpoint of the 20s, so around about 25 PE. And that still would appear to be the case on today's current price into 2023, which the market will start pricing in fairly soon. So let's assume, because 24 times PE for a compound annual growth rate of 5% is out of whack. No matter how good the stock is perceived to be, that's just out of whack. And so I think it's highly likely that in the next 3 months, 6 months, 12 months, that the market slowly comes to that realisation. And again, I'm not picking on Wesfarmers here. I could make this case with another 20 or 30 stocks. So this is purely an example. I think there's going to be this slow unfolding realisation that stocks on these sort of PE ratios of mid-20s to high 20s to maybe even low 30s that just aren't growing their earnings strongly enough. And there is going to be a PE contraction. Now let's assume that the PE contracts just down to 18, which to me, for 5% growth, is still too high. But let's assume that it just comes down from 24 down to 18. Well, that represents at $2.10 a share of earnings, that sees the price fall 24% from its current level down to $37.80. And $37.80 would bring you all the way down to about here. So you could argue that there's still quite a fall ahead over time for a stock like Wesfarmers and many, many others. Now, for this not to happen, Wesfarmers needs to kick its earnings per share up to well beyond 5% growth and probably something more like 15 to 20% growth to be able to sustain this sort of PE multiple. And I think that's the only thing that's going to save it. So then you've got to ask yourself, well, given all the headwinds that are just going to keep intensifying, particularly around inflation and supply chains and all those sort of things, how likely is that sudden burst upwards in earnings growth likely to happen? And the answer you've got to conclude is it's not. So that's why I think if you've got a traditionally diversified portfolio, you really want to think very, very hard about what you want to own. Now, we did achieve yield inversion in the bond market, which is something that certainly the commentariat grabs a hold of and runs with. So I think you're going to see an increasing amount of discussion around that. So I want to look at, should we be fearful of this bond yield inversion or should we not? So I'll just make a few points here. First of all, the 10-year, 5-year spread had inverted, I think late last week, the week before. The 10-year, 2-year spread, which is probably the most watched of the spreads, so that means that the 2-year yield has now gone above the 10-year yield. That's what inversion means. Well, that just happened on Friday, so it's now joined the club. And we've got the 10.5 and the 10.2 yields now in inversion. So expect to see the market commentary really ramp up, and it's going to be highly misleading because you're going to read a lot of stuff and hear a lot of stuff that this means that a recession's coming and the stock market's going to fall over. But the actual reality, when you look at the numbers, is that from the point of inversion to the actual confirmation of a recession, which is 2 quarters of negative GDP, averages around 18 months. So that's the first point. The second point is that from inversion, and again, this is on average over many decades, from inversion to the peak in the S&P 500 is something close to 20%. So the S&P continues to rise by something on average around 20%. So this is not something to be anxious about in the near term. It just isn't. We've got history on our side. So inversion itself is a pretty poor indicator for timing highs and lows. So when you read all the rubbish that you're going to read in coming weeks and months, then, just discount it heavily. But the really big question is, how does it impact the specific stocks that you own? Because if you own a Wesfarmers, then, or many others, then yes, you're going to be impacted. But if you own a really strong, high growth, high probability stock in a mega trend area, then it may not have any impact at all. So, please don't at any stage adopt the attitude that I've just got to sell all my stocks because there's a recession coming. Because you can still own some very good stocks and do very well. But it depends, incredibly on what you own. And I just pose this question. Would a recession stop what's happening in lithium, copper, nickel, graphite, rare earths, etc., which are all part of really these unstoppable mega trends that are going to go on for years and decades? Is it going to stop those stocks? Now, yes, if you get a recession, the sentiment around the stock market is more negative, so it'll probably stop those stocks advancing at the rate that they have been. But will it actually stop them from reaching their end goals? I just can't see that at all. So I think this is a really important perspective because the biggest problem that inexperienced investors have is that they just get drawn in by the media. They get drawn in by the logical conclusion, which often doesn't pan out because the stock market is looking forward. It's not dealing with the facts today. It's dealing with the facts next year and the year after. So let's turn to American stocks now. The S&P was almost flat. It gained just 3 points across the week, but the good news was it did hold comfortably above the 200-day moving average. The sector ratios have recovered. There's no question about that, and I think you can feel pretty confident that the lows of the correction have been formed. But they're just not as robust as I would like to see. Now, I guess you can't have everything, but I'd just like to see them a little bit more robust than what they are. The US dollar, slightly lower, not much in it. The 10-year yield up and down between 2.3 and 2.45. The VIX is now down under 20, so that fear has gone out of the market. And as I covered earlier, the 10-2 spread has now inverted. So let's take a look at some of those charts. So this is the 10-year. So let's just put this on a 3-month basis so you get a better view. So you can see we've been up to around 2.5. 2.5 down to 2.3 has been the range over the last few weeks. But clearly the yield is heading up quite strongly. But yield inversion, which was what we've now got, means that the 2-year yield is actually higher than this, because you can see we've now gone negative. So the 10-year minus the 2-year is now negative 0.06. So, that's the situation that we have at the moment in that market. Let's take a look at the S&P just for the record. So the 200-day moving average didn't ever stop rising. The shorter term moving averages did dip and the price went down. But it would almost appear certain now that we've seen the lows. I wouldn't discount, particularly looking at some of the spreads, which we'll look at in a minute, I wouldn't discount another higher low. So I wouldn't discount something that looks like this occurring. But we'll see. As always, I'm just driven by what the market gives me. I don't have any real preconceived ideas that I get hung up on. So let's look at the sector spreads. Okay, just let me navigate to the right one. So this is the NASDAQ 100 versus the S&P. You can see we had a very strong rebound, relative rebound in the NASDAQ, but it did come off the boil on Thursday and Friday. We had a little bit of weakness there. This is the Dow Jones small caps versus the small cap growth versus small cap value. So not a lot of change there. We haven't really gone up or down. Money has been flowing back into small caps. There is other evidence of that. If you look at the ARK funds, for instance, the ARK ETFs, they've started to look a little brighter. So I think money is going back into some of those smaller cap stocks, and also the Russell 2000 has kicked up as well. But it's just sort of going equally into both aggressive and defensive sectors. This is the chart that I'm after. Yeah, so this is consumer discretionary versus consumer staples. A really strong rebound in discretionary, but again, came off the boil in the last 2 days, and money flowed preferentially into staples. So it was a bit of a move to the conservative side. And this is the Russell 1000 growth versus value. So it's okay. I think we've formed the lows, but it's just not quite as bullish as I would have liked. If we look at the Russell, you can see where we've broken out of this range, then pull back into it. But at least now we appear as though we're setting higher highs and higher lows. So small caps not being left out either. Turning to the currencies, there's the US dollar, ended up net down just a little bit. But the Australian dollar was really strong. So we've continued to hold up right near the top of the range here at around 75 cents to the US dollar. So 74.4 is where we ended. Our index gained 1.2% across the week. It was really down to the mining majors, BHP, Rio, Fortescue, etc. And that index broke to a new high. So that was the main assist in the overall index going up. But there was a lot of smaller miners in Australia, a lot of the development stocks in battery materials that just had such a powerful week. And with lithium prices just absolutely going ballistic, it's no wonder. So, that's certainly been the place to do extremely well of late. So let's just look at there's the major miners. So XMJ, and you can see we've now broken to new all-time highs, and it's been a very powerful couple of weeks after chopping around for a few months. So a great deal of strength there. There's the ASX 200. We're not too far off the all-time highs, around 7,600, but it's largely because of materials and also energy. So energy has done extremely well as well with the oil price. Precious metals, gold was down $23, down to $19.25. It's just continued to consolidate, but as we'll see on the chart, it's consolidating high. It's consolidating not far off the all-time highs, which is a positive. When stocks consolidate up near their all-time highs, it's generally a good positive. But I don't know, maybe we've just been disappointed, or I've been disappointed so many times with gold in the last 3 or 4 years that, I'm finding it hard to get the trust in gold that I have in lithium and nickel and copper and rare earths, etc. So I'm preferring just to sort of sit back and watch and trade things that have got a higher probability, because I think we can all feel pretty confident about where all those metals prices are going. I just can't get the same level of confidence around gold, until it actually breaks out and proves itself. Precious metal stocks, though, are leading the way, and that's a positive. And we've had short-term outperformance now against the metal for 3 or 4 weeks, and it's continuing. So at least that's a positive for the gold bugs out there. Let's take a look at the gold price. That's it on a daily basis. So we haven't really done a great deal. We had a big spike in early March, which was associated with the start of the Ukraine war, and then it's come back out again. That premium has come back out again, and we've just consolidated. But it's more obvious when you look on a weekly chart. So we're consolidating high. We're only $100 off the all-time highs, consolidating high and holding above this support level. So that is at least a positive for gold. And if we look at GDX, also doing really quite well. And if you look, I'll go back to that spread chart, which shows the difference between gold stocks and gold itself. So this is looking quite positive for gold. Now, it's not the all-time highs, but it's certainly a meaningful peak to get above. If I just go back to the spread charts and try and find that, this is the one I'm after. So this is gold miners, GDX, versus GLD, which is the ETF that tracks gold. And you can see we've had a very strong couple of weeks. The bottom was around the 31st of January, 1st of February. So we've had nearly 8 weeks of relative outperformance. The line rising means that GDX is rising faster than GLD is. And if we take that out, pan it out further, we're still a long way off the all-time highs, and we are still in this big consolidation band that's been in place since 2014. So this is this is a situation that's lasted now for nearly 8 years. But if we can break out here, and gold stocks can get above 0.24 on this ratio, and we closed it at 0.22 on Friday night, then we could have a different situation. I think you might see gold miners start to get a really significant bid. Turning to other commodities, copper was pretty much steady at 464. Nickel continues to be quite volatile, but finished at 1497. But look, the volatility is certainly settling down compared to what it was when the big short happened. And just on copper, a quote from BHP, or a forecast from BHP through the week, which caught my eye, saying that the world is going to need twice as much copper in the next 30 years as it has in the last 30. And when you consider that the low-hanging fruit has been picked decades ago, they've got to go deeper to find very significant deposits. They've got to go to jurisdictions that have got much higher sovereign risk, because a lot of the tier 1 jurisdictions have been discovered. So discovery is going to be harder. There is all the concerns around, what mining means to ESG. So you've got to think it's a big challenge to produce not only what the world produced in the last 30 years, but then to double it again. So again, the logical conclusion, we need to be careful with logical conclusions, but I think there's some very significant odds against the price of copper continuing to rise, along with nickel and along with lithium and along with many others. Now, the West Texas Intermediate crude fell somewhat, down to 99.42. But perhaps OPEC is releasing some more oil into the market, and certainly the US released some of their petroleum reserves as well. Aussie motorists would be applauding, I guess. We've seen petrol prices at $2.20. or at least they have been in Perth. I saw some at $1.70 just this morning. So, that's a very significant fall from where we were just a week ago. So that's the good news. There's the spot copper chart. Spot nickel for 1 year, but just to zero in on the last 30 days, just to give you an idea of the sort of volatility. It doesn't look much on this chart because it's so volatile over on the left-hand side, but, fluctuating over $1 or more, closer to $2 in the very short term is certainly incredibly volatile. So wrapping it up, my final thoughts, there are headwinds coming. There's no question about that. You've got your head in the sand if you don't think that things get tougher and tougher from here on in. And that's, even if we do get resolution in the Ukraine and China doesn't make a move on Taiwan, I still think there's going to be headwinds coming anyway. They're going to impact most stocks, but not all. And the impacts, as I said earlier, are going to vary quite dramatically. What you own has never been more important, and how you manage it has never been more important than it is right now. So one of the things that I've tried to convey a consistent message for many, many years. I've been doing these videos now for 16, 17 years. But in probably the last 5 years, I've been very consistent in saying that if you invest in a traditional consensus method, then you're going to struggle. And there are far better ways to go about it. I think it's almost a given that the average PEs for the top 200 stocks are going to contract. That's why I showed that Wesfarmers example. And I think we're going to see that in many, many stocks. And so the only alternative is that there's got to be some pretty large earnings per share growth needed to hold the prices up, because the PE multiples are going to come down. And in a challenging environment, how do companies improve their earnings growth when they haven't been able to do it for the last 5 years? How are they going to do it for the next 5? Portfolio analyst last week spent a lot of time looking at how we manage stocks during a big run. And we've certainly had some of those in the Australian mining sector in the last week or two. And also the stocks that I'm watching closely in the megatrend areas. So that was Portfolio Analyst last week. It's available as a $1 trial for 2 weeks on a once-only basis. And I think you might, if you haven't tried it, I think you might find a lot of value in there. There's the website address. There's more information there. There's my email address. And I'll be back with you next Sunday. Cheers.